So welcome to this video. In this video, we are going to discuss about December 2014 problem and the topic is NPV. This is a quite different problem when compared to the normal NPV questions that they have asked, because here what they have done is they have given already worked out NPV problem and they also give you some notes. At the end of the note, they ask you prepare a revised draft evaluation of the investment proposal and comment on its financial acceptability. So this NPV which is done is wrong. Okay, somewhere there are like small mistakes and there are like notes as to how this NPV has been like prepared. So you have to first find out like what are the mistakes and how the correct numbers have to be worked out, and you have to then explain just two of the errors that you have spotted in this NPV, and uh, you have to give your comment on it. So that's about this question. So we are not going to work out this problem, it will take a very long time. So what we'll do is we'll just spot what are the various types of errors that are there in this question. Okay, so we'll start. Uftin Co is a large company which is listed on a major stock market. The company has been evaluating an investment proposal to manufacture a product. The initial investment is 1.8 million, will be payable at the start of the first year of operation, that is the 0th year. The following draft evaluation has been prepared by a junior employee. So sales is given, selling price is given, variable cost is given. The above selling price and variable cost units have not been inflated, so it is our job to inflate it. So they have given you sales numbers. So first we'll see whether the sales numbers are properly inflated. We have to check. They have given us variable cost, fixed cost, interest payments, cash flow before tax, taxable depreciation, taxable profit, taxation, then discount factor they have given. They have also found the NPV. So they have given us some notes. We'll start from the notes. So they say that relevant fixed costs are forecast to be 1,50,000 per year. So the relevant fixed cost has to be 1,50,000. Have they taken it? They have taken it as 1,55,000, but still we'll read all the notes. Sales and production volumes are the same and no finished goods have been held. So there's no mention about that in this problem. The corporation tax rate is 22% and tax liabilities are payable 1 year in arrears. So that they have taken the first year in the second year, second and third year in the fourth year, but in the fifth year there is no mention of it. So if you want, you can mark it like this: mistakes made in the NPV calculation. Okay, so the first one is tax for the fourth year is missing. Okay, so so that is a problem. The fourth year tax is missing. If you want, we can mark it with a box. So this is missing. So next one, Uftin, and there's also tax allowable depreciation. So tax allowable depreciation is like taken, but it is not taken for the fifth year. So again, that is also a mistake. So 4 years have taken, but it's not in arrears. So we can put it like this: tax allowable depreciation is not taken in arrears. Okay, so that is a second mistake, because here they have mentioned the tax is payable in an arrear. UCO can claim tax allowable depreciation of 25% on a reducing balance basis on the investment. So we are not going to calculate that, but still if you look at the tax allowable depreciation is only 450, but here they have mentioned it as a written down reducing balance basis. If it's like the same number, it means they are using straight line method. So depreciation is calculated on straight line method and not return down value method. Okay, so that is not being done. So if you want, you can mark that also. So these numbers are wrong. Okay, this entire stretch of numbers are wrong. So that's our third one. So we'll just go to the next one. A balancing charge or allowance can be claimed at the end of fourth year. So that we can't like now calculate it. It will take a long time. It is expected that the selling price inflation will be 4.2 per year, and the variable cost inflation will be 5 per year, and fixed cost inflation will be 3 per year. So for selling price inflation, we can try to find it out whether they have inflated properly or not. So we can work it like this. Sales inflation, whether they have done properly or not, we can find it out. So we can take it as year 1, 2, 3, and 4. So we have selling price. We can inflate, and we can have the units, and then we can have inflated sales or sale inflated sales. Okay. So selling price is 25, again 25, 26, and then 27. Inflation will be, inflation we will take it like this. So inflation can be 1 here. So sale inflation will be around 4.2. So we can take this number, we can add same number, the same number into 4.2%. Close the bracket. This will be the inflation. So we can take it for all the 4 years, and our sales number, so our units is going to be, our units are 95,000, 1 lakh, 1 lakh 50, and 1 lakh 50. So when we multiply the inflation rate, sorry, the selling price into the inflation into the units will give us the answer. We'll check whether these answers are correct. So the sales number is 2475, that's correct. 2605, from here it's wrong. If you take from the first year, it is wrong. Sorry, from the second year it's wrong. So I can mark it as point number 4. Sales inflation is done wrongly. So that's about the 4th. So we'll check whether the variable cost is like at least properly inflated. So variable cost inflation is around 5%. So rather than this number, we can take it as 5%, and we can just copy and paste it, and we'll just check how much is variable cost. Variable cost is 11, 12, 12, 13, 11, 12, 12, 13. So variable cost is done, inflation is done, units are multiplied. So the answer comes to 1097. Then it comes to, okay, units have been like wrongly done, it's 100. Okay, so it should be 1097. That's right. Then it should be 1260. Again, it's wrong. So we can copy it and we can paste. Variable cost inflation is wrongly done. Is there any other mistake? So any other mistake is the fixed cost. Fixed cost has to be inflated by 3%. He has done only for the first year. From there on, it is like totally wrong. So again, the fixed cost is wrongly inflated. So if you want, we can just copy it and we can do it. So the fixed cost is wrongly inflated. So that's about the 6th point. Interest payments will not come in NPV calculations because inflation interest payments are taken as the discount factor, so they will not come, but it's wrongly done here. Interest payment will not occur in NPV. Okay, so again that is another wrong thing. That is the 7th one wrong. The investment doesn't have a scrap value. The investment is partly financed by 1,50,000 at 10% interest, and Uftin has a weighted average cost of 12%. All other numbers seems to be right except for these errors. Okay, so these are the error. Uh, there's a very little probability that you will get this kind of a sum, but ensure that you understand how these mistakes have been done, because these are the typical mistakes that a student makes in an exam. So that's why they have given this question in an examination. So ensure that you don't do these kinds of mistakes in an exam. So thank you very much for watching this video. We'll meet in the next video.